Welcome to week 7, Business 630 students. This is Professor Hassey. Our topic this week, strategies that drive capital decision-making. Chapter 22 of your text, if you have it, but all the material is supplied in Blackboard. There's a couple of articles I'd like you to read this week. Some analysis that I'm talking about in this video, and also some further analysis that I'll be talking about in my Friday update video on Friday, December 10th. This week, you are working on and begin to working on case number 4, which is not due until Sunday, December 19th. And many of you are continuing your work on the electrics case, which is also due on December 19th. We have a review session on Saturday, December 11th at 10 a.m., which will be entirely for a review of the electrics case. And also we have our office hours on Thursday, December 9th at 6 p.m. if any of you have some issues that you'd like to go over with me via Zoom. So our chosen format for today is to talk about the definitions of alternatives to capital decision making. And this will be our basically our topic for the final 2 weeks of our course. This week, we're going to talk about mergers and acquisitions and how are they defined. You have a question in your case that talks about asking you to do a little research about your company's history of mergers and acquisitions. And then we also will talk about next week leasing as an alternative capital strategy. So first of all, let's take a look at a case, before I get into that, we'll take a look at case number 3 on Friday as well in our update video. Case number 3 grades will be posted by Friday, and I'll review that in addition on my Friday video. So a lot of videos in the next couple of weeks, and I hope you bear with me on that. But we keep things going forward, and we can wrap the course up and in good shape for all of you. In the amount of case number 3 I have already graded, everybody did a super job, and I'm very pleased with the performance of the PowerPoints thus far, and those grades will be posted by the end of the week, and we'll talk about that in our Friday update video. Let's take a look at a video that defines the basics of mergers and acquisitions.
This video segment discusses mergers and acquisitions in the context of strategic management. Merger and acquisition activity is extremely important in strategic management as we continue to see larger and larger deals in front of us. One of the more recent in the acquisition area is that of Google's proposed acquisition of the Motorola cell phone business for $12.5 billion. This signals Google's desire to further diversify away from its search engine business into an area it thinks has great potential for profits. It's instructive to differentiate between merger and acquisitions because they are quite different. In a merger, what you'll have is two firms of somewhat similar size that just combine their assets, and their names typically become combined as well. You may recall the failed merger some dozen years ago between Daimler and Chrysler. Their names became merged. Acquisitions are quite different. This is a situation where you find a larger or more cash-rich firm buying a smaller organization. The smaller organization then comes the subsidiary of the larger organization. If the Motorola acquisition goes through, Motorola will become a subsidiary of Google. In the not too distant past, Kraft paid $20 billion to purchase Cadbury. Kraft is a United States convenience food manufacturer, and Cadbury is a confectioner into chocolates and chewing gum, and they are located in the United Kingdom. Kraft paid almost $20 billion to purchase all the assets of Cadbury. In the business press, we quite often see merger and acquisition activity discussed interchangeably, but these terms mean something very different, as you can see from this and from this slide as well. In the situation of mergers, you have a situation where either the names become combined or one of the parents may become the dominant player, and they're simply named after the larger or the more dominant organization which comes through in a merger. One of the parents, regardless of how their name changes or does not change, usually emerges as the dominant management team. I don't know what the case in Sirius XM radio is, but I do know that Daimler, a German company, became the dominant management team of Daimler Chrysler some years ago. In acquisitions, you have a situation where the acquirer, which was Kraft Foods in this case of Cadbury, just buys out all of the firm's stock. So they bought all of Cadbury stock for nearly $20 billion. And these types of activities can be either friendly or hostile for the acquiree. There are several types of merger and acquisition activity, and I'm going to detail five. Vertical activity in mergers and acquisitions could be simply to buy a supplier or customer. So they're vertically going forward or backward to streamline their cost structure. And Johnson & Johnson acquired some time ago Mentor, which is a latex glove company, among other things, to complement its products to become a supplier to other divisions of Johnson & Johnson, hence streamlining its cost structure. In the case of horizontal merger and acquisition activity, we see a situation where you merge or acquire a competitor. And we've seen that in the recent past, in so much as that the Dutch firm InBev bought out Anheuser-Busch, thus reducing their competition to some extent. Product extension is a situation where you're buying complementary products or acquiring them to fit your portfolio. And in this case, Kraft's acquisition of Cadbury is a perfect example of complementary products. It also exemplifies market extension, which is where you want to go into different markets. If you studied the Cadbury Kraft acquisition, probably the main reason that Kraft wanted Cadbury so badly is that Cadbury does very, very well in some emerging markets where Kraft does not do very well. And namely, those two markets are India and Brazil. Cadbury does very, very well there. Kraft has had minimal success and hopes to piggyback off Cadbury's leverage in those two large emerging economies for Kraft to do well. And that's market extension. And then there's also this unrelated firm of merger and acquisition activity. We call it conglomerate merger and acquisition activity. And this is a constant strategy that General Electric undergoes. General Electric, if you look at their web page or their annual report, they are into a wide host of products, from light bulbs to appliances to jet engines to medical imaging products in the healthcare industry, and many more industries as well. So it buys firms that are quite different, but at the same time it diversifies their total risk by being involved in a lot of different industries. The logic behind this related merger and acquisition activity, when you buy something that's related or you merge two firms that are related, what you hope is that you have value creation. And that is what's hoped from the merger between Sirius and XM. They need to create value because both firms were losing money. And we examine this when talking about the value chain. Part of that value creation is going to come from cost reductions, hopefully through economies of scale, or a larger new satellite radio organization being the new merged company. And also another value creating activity we see called economies of scope, and that is situations where firms can share competencies. And really this goes back to the value chain as well. They can share branding, name, content, subscribers, etc. There are some implementation issues in mergers and acquisition activity. No better illustrated than in the case of Daimler and Chrysler. And that's in cultural differences. A German organization merging with a U.S. organization. Merger and acquisition activity always requires the merging of two different cultures, whether they be from two different countries or from the same country. You're still going to have two different and often quite disparate organizational cultures. That was a big problem for Daimler and Chrysler. Cultural merging involves a number of things. Among other things, involves the combination of elements of two different cultures, management styles, products, customers, etc. It's interesting to see what's going to happen if the Google acquisition of Motorola happens and the Kraft acquisition of Cadbury, as of this speaking of late 2011, is already complete, and we still have not seen yet the full effect of the combination of both cultures. We do know in the case of Kraft that Cadbury has fought this over in the United Kingdom because they're not happy about an American company buying out their company, and many are unsure about their stability as an organization going forward, thinking Kraft might take the chocolate company and move it back to the United States. So it's difficult, costly, and it's not always possible to pull off a merger and acquisition from the implementation side. One last thing I'll say is that merger and acquisition activity is kind of risky, but it's especially risky in the international side. Research shows that 70% of all mergers or acquisitions that take place between firms from different countries are going to fail. So if you think about that, your odds of making a merger or acquisition work when you have headquarters from two separate countries, your odds are not very good.
That's an excellent video, even though the examples the the author uses is a little bit outdated, like 10 years ago. It gives us great definitions. Instead of reading the chapter, that one video of 8 minutes pretty well sums up all of chapter 22 of the definitions of mergers and acquisitions. I think one of the key things, and also gives you a basis by which you can do some research in your case number 4, where I ask you to go back to the year 2000 and see in that time from 2000 to 2021 currently, has your firm that you selected at the beginning of our course participated in any mergers or acquisitions? One of the key things of justifying a merger is it's a changing of strategy of a company, and you're looking to change the synergy of your business, operations, financing, management. Also, taxation has a huge effect on the merger of a company. Tax breaks, going into other countries, other states, huge synergies involved with making the decision to merge. Operating economies, like they was mentioned in the video, you can cut down your cost. Instead of having 3 accounting departments, you can have 1 accounting department for a merged company. Have 1 HR office, 1 technology office. The financial economies of expanding your markets, the better management. Many times companies merge because they find that their management will get more efficient and better by bringing in new talent in that merger. So there's a lot of synergies, a lot of justifications for mergers. Also, if you decide down the road, which happens a lot, and you read about it in the newspaper all the time, when you merge, many times they take that merger and then they break up the assets. They sell off some assets to generate cash flow, to sell off some of the businesses. One of the reasons why you merge is to acquire assets, and then immediately you break them up, you sell them, you obtain cash flow. That's another valid reason for a merger. One of the reasons why it's questionable to have a merger is it really is a diversification really going to help us? Are we going to get more technical, more different products to manage? Are we going to be able to manage that? And also it goes back to what was talked about in the video, the cultural aspects, merging different sizes, different ways of doing business. That can vary, that can cause a lot of problems with a merger. But if it's a friendly merger that is supported by 2 companies, that usually works out the hostilities, usually works out the problems of the merger, especially if they're friendly. If it's a hostile takeover, all bets are off. Hostile takeover means a management resists the merger and the acquirer goes around management by targeting the stockholders to obtain majority control of the company. That's a hostile takeover. I'll give you an example. Many years ago, probably when you guys were in elementary school, no, probably even before that, there was a company in Boston called WordPerfect. And they were the first major software developer of word processing. Well, right about that same time, Microsoft, who had been building operating systems for the new computer industry, if any of you remember the DOS operating system, Microsoft was beginning to acquire cash and was looking to start expanding their business, going to new products. Well, one of the things they needed is applications to work with their software in managing their computers that they're issuing or working with. One of the big ones was IBM, the first major personal computer market. So Microsoft went out looking for applications. And one of those applications they wanted was WordPerfect, word processing. And they went to the management of WordPerfect and they said, "Hey, we'd like to merge with you. We could give you a deal. We'll give you a great price on your stock. Would you like to come and work with us?" And the management's first question was, "Well, what's going to happen to us if we merge with you?" "Well, you're going to lose your jobs," Microsoft said, "but we're going to pay you a lot of money so you don't maybe not ever have to work again." Well, the management said, "Get the hell out of here. We're not going to sell to you." So Microsoft said, "Okay, fine." The next day they took on an ad in the Wall Street Journal. And the ad said, "To all shareholders of WordPerfect, we're going to offer you triple the value of price of your shares of stock in the market. We would like to partner up with you in your business and have you join Microsoft." The majority of the shock stockholders saw that advertising and sold immediately to Microsoft. So Microsoft went around the management who didn't want to merge and basically bought out the shareholders with the cash that they had in their business. That's an example of a hostile takeover. And for many of us in our business life, we might be associated with companies that are taken over or merged. The result is people will lose their jobs while other people will become very wealthy. Here's one of the reasons why mergers make sense. It access to you to new markets and technologies. You can spread out the risk of the expenses over a wider area of the company. You can work together as you were used to be rivals. Now you are partners. And also, antitrust laws can shelter cooperative R&D activities. In other words, yes, you're merging and becoming bigger, but antitrust laws can protect you from certain research and development activities. What that means is R&D is developing new products, developing new markets. With the antitrust laws, you can't go outside your business to develop those activities. They have to be generated within your company. Well, that's no problem since you now have merged and become bigger and have the talent and the capital to do that. It basically protects you from outside acquisitions of coming into and taking over your new merged company. One of the things we're going to talk about in our Friday video is what is called APV, how to determine the value of a merger. One of the main reasons that you merge is to make your company more valuable in the market. Stock price goes up, more wealth. Well, how can you measure that wealth before the merger takes place? Okay. And we're going to determine that somewhat simple calculation of determining what your future cash flow is going to be off your firm that you're merging with and dividing that by the cost of capital. That is called an APV formula to determine the value of the new company. Once you do that, you can sell the merger to investors, to your employees, because the company is going to be more valuable by putting that together. In other words, if I have a business now that generates $2 million a year in free cash flow. Now, free cash flow is basically profits. $2 million. But if I decide to merge with another company and my free cash flow goes from $2 million to $10 million, in one fell swoop, I'm creating massive amount of new value for this business. It makes the company more attractive to investors and less riskier in the market. And we'll talk about that in our Friday video. In our week 7 Blackboard for this week, there's a couple of things I'd like you to look at. This is the video that we just saw in this presentation today, but there's 2 articles I'd like you to download and read. Strategy Without Disrupting Your Organization and Measures That Drive Performance. I'd like you to read those and see maybe in some cases you can incorporate that in some of your case 4 work, but better yet, just read them to get you acclimated to different ways of doing strategic decision making. Read those 2 articles. Here's one of those articles: How to Implement a New Strategy Without Disrupting Your Organization. One of the things that happen in mergers, one of the things that happen when you acquire capital and you grow your business, is one of the things that usually result is you disrupt the organization. The organization changes because of this new capital, because of this new merger and acquisition. You see that every day in companies. Well, how do you develop a strategy that will not disrupt your organization when change develops? This is an article that explains that. It talks about how you set up your management organization, your business organization, how you communicate with your employees about the strategies and going forward. This is a great article that a lot of you probably could relate to, because I know in any organization that I've ever been associated, when we try to change the culture or change the business strategy, people get nervous. Am I losing my job? What do these people know about change? It causes disruption. How can you implement a strategy that avoids that? This is a great article for that. The second article that I want you to read is a very important article, because a lot of us have been, throughout our business studies, have been inundated with the SWOT analysis: strength, weaknesses, opportunities, and threats. We use it a lot. Well, here's another approach that takes a different approach to the reason why you do a SWOT analysis. It's called the balanced scorecard that measures and drives a company's performance. I used to use this quite a bit when I was looking at companies to invest in, or looking at companies that were asking for my services of taking a look at their organization. It's called the balanced scorecard approach. And that balanced scorecard approach is basically a way of looking at finances, internal business management, innovation within the company, and customer perspective. So instead of a SWOT analysis, it takes a look at different perspectives of the organization and how they relate or do not relate. This is an excellent strategy for a lot of companies, instead of SWOT, or do both, as a way of measuring the efficiencies and the strategies of capital decision-making, mergers and acquisition, leasing, whatever, which we're talking about in the next few weeks. This balanced scorecard approach is a very good thing to have to understand as you develop your business career and your career within organizations when you are the decision maker. How does change disrupt organizations, and how to measure those performance changes? The balanced scorecard approach and the other article on disrupting organization are 2 good articles that I'd like you all to read for this week. So you have a new case that I talked about in my introduction video the other day. It's called Alternative Capital Resources, and it takes out a variety of different questions about mergers, about leasing, which we'll talk about next week, about ways of doing business differently than the traditional method of going out and borrowing capital or selling stock. So we're going to study that this week, and that's one of the topics of case number 4, which is now posted to Blackboard. And the best thing about this is you have 2 weeks to do it. It's due on Sunday, December 19th. The bad thing about it is it's due the same date as your electrics case, but hopefully you're making progress. I know a lot of students have been sending me questions and samples of their work in electrics. Please continue to do that. Let's wrap this up this week. We have our office hours, student hours on Thursday evening. We have a review session Saturday morning, which will be recorded if anybody cannot attend, and I'll post that recording. And then on Friday, we have an update of talking about the ways of valuing corporate mergers and acquisition, how to place a dollar value on those those mergers. Also, we'll review case number 3, which the grades will be up by Friday, and we'll move forward into our last week of study. So as we finish up this week 7 and head into week 8, one of the things I want you to be aware of, and I've mentioned this in other videos, is I realize you all are doing a lot of work, a lot of pressure, a lot of studying, a lot of analysis, a lot of unknowns. So remember, take advantage of using me as a reference, as a source. If you get behind, come to our review sessions, come to our student hours, look for material that's provided on Blackboard, and try to consolidate your thinking by each assignment. Electrics case 4. So if anything I can do to help you all out of that in the next couple of weeks, I appreciate that. Another thing that you've probably received today in the email from the University of Laverne is the course evaluation link to evaluate this course. It's not due until September 20th, so you don't have to worry about that right now, but I please would like you to consider that as you finish up your work in our 6:30 class of evaluating the class, giving me some feedback about the material and about this course. So think about that down the road. You probably got that email today or tomorrow from the University of Laverne, and we'll talk more about that later on next week. So as we look forward to our weekend and doing some review and talking about our cases and our study, I wish you all good luck this week. I know you're doing a lot of work and you're doing great. So hang in there, only a week to go, and I'll talk to you all soon. Thanks, everybody.